Regular Insight viewers recognize her right away. She's a valuable resource in planning and sustaining our retirement. Heather Foster is an investment advisor and fiduciary. Today we want to talk about risk in investing and planning our retirement. I guess how much risk we want to take depends on where we are in that
walk of life.
Yes, I was going to say how old I am, but
how
you know.
So risk is just something that I wanted to bring up because I think that a lot of times people focus on risk when the markets are going down, right? They start to go, I don't want to be like this, and it's the appropriate time to really talk about risk and to maybe make adjustments is definitely not when the markets are down, they're when the markets are at highs, right? So I think it's important as we kind of go into the next few years. We've had a lot of growth in the stock market. Everyone's been very happy with the stock market results, especially after COVID and everything we've been dealing with. So it's a good time to actually look at risk, making sure that you're looking at your portfolio, having ways to go in and actually see the way that you're currently investing. Do you know how much it would go down if we have another recession at some point? You probably know what kind of returns you've been getting because, again, we've been focused on those returns, but making sure you understand the downside risk in a portfolio and that you mitigate that risk prior to having any sort of recessions or major corrections and making sure you're ahead of that while the markets are at all-time highs. So we're going through our entire client book right now and making them all fill out new risk questionnaires, and they're like, why do we have to do this? We have to do it actually every 3 years. You should make sure that you're doing it every 3 years, and sometimes you need to do it even more than that to make sure that the risk that someone's taking is something they're going to be comfortable with. Again, because if I'm going to realign if I'm going to adjust their portfolios, it's a great time to do it. We don't want to do it when the markets are low or going down or trending down. We want to do it when the markets are high. We've talked about it before. It's actually not an age thing, so don't worry about that. It's not an age thing when the way that you should be investing your money. The way that the risk tolerance should be for you really has to do with the time horizon the money has. So the reason why people think age is the thing is because they're like, well, the older I get, I have less time. But if you're someone who's not going to be pulling money out of your investments in the first place, what's the real time horizon?
Right.
So if you've saved up enough money and maybe you've got a pension and Social Security and that's all you need to live on, the investment money is just really there for what?
To be left to someone.
To be left to the next generation. So what's that generation's time horizon? It might be years and years and years before they actually spend that money. So someone in that scenario can be a lot more aggressive with their risk tolerance than somebody who's actually needs their income off their investments. They're taking withdrawals from those investment accounts. That person needs to add some conservative money into it. My golden rule is at least 3 to 5 years worth of any income needs that you need to take out or any large withdrawal. So if you've got a remodel plan, everyone's doing construction right now, that money needs to be set aside into something more conservative. You can have the rest more aggressively invested because you're not planning on using that money anytime soon. So 3 to 5 years, the reason why I use 3 to 5 years is because when we do experience recession, the average recession recovery period is about 3 years, 3 to 5 years. So if you've put to the side anything that you might need over the next 3 to 5 years, and as you use it, you replenish it at, again, market highs, not market lows, you'll always have a bucket you can tap into. So even if we do experience a recession or major market declines, you won't be that person like in 2008 that goes, because the markets went down, I can't retire now. The only person that should have been able to say that was the person that didn't have that conservative bucket put into place ahead of time, because they actually went down and then they're going, I can't retire because if I retire, I'm selling low. So they have to put those into perspective ahead of time. So risk is it's an extremely important topic. Allocation structure, and then emotional risk, right? Emotional risk is where you as the client are calling me saying, I just can't handle this, get me out, right? That's emotional risk. As advisors, we do have to take that in consideration as well, making sure we're not putting somebody, even if they can handle the risk.
They can't handle emotionally.
But if they're emotionally, you're going to call us and say, hey, sell me out while the markets are going down, that's a bad maneuver as well. So making sure that emotionally we're set up correctly. And the big thing there is those withdrawals. If you're going to use your money in the next 3 to 5 years, get it off to the side, harvest those gains right now while the markets are high. Make sure that you're consistently talking about risk, that you're in the right place at the right time.
And listen, now's the time. Take that risk assessment, figure it out. And it's always good to reassess, especially if you've had any life changes too. That's a great time to do that.
We do have a risk thing on our website as well.
Well, check that out today, fosterfinancial.net. Check out that risk assessment and give them a call today, 234-2200. We'll be right back.